Welcome to the Deep Dive, your shortcut to being truly well-informed. Today, we're digging into Gambling.com Group's Q2 2025 earnings conference call. It wrapped up August 14th after the market closed.
Yeah, and it was quite the interesting situation.
Definitely.
Oh.
Because here's the thing we're going to unpack. They posted some really strong numbers. Beat expectations pretty significantly.
Right.
Yet, the stock took a noticeable hit the next day.
Yeah.
So what's going on there? What did the market react to that maybe wasn't obvious in those headlines?
Exactly. It was definitely an eventful call. You had that strong top-line performance, but you also had these clear market jitters that led to a pretty swift, cautious reaction from investors. So we're going to break down what drove that feeling, what it means for where the company's heading strategically.
And maybe why those signals, even though they seem contradictory, might actually point to something compelling.
That's the plan.
Okay, so let's kick off with those headline numbers because, honestly, they were impressive. For Q2 2025, Gambling.com Group reported adjusted EPS of $0.37.
Which was huge compared to the consensus, right? That was only $0.12.
Exactly. A massive beat. And revenue came in strong, too, $39.59 million. That was above the $38.92 million consensus.
And represents a 30% jump year over year. Solid growth.
Solid indeed.
But, and this is where it gets interesting, despite those beats, the market's reaction, well, it was fast and definitely cautious.
Yeah, the stock dropped pretty notably the day after the call and on really high trading volume, too.
Right. And that mixed feeling, that's what we want to pick apart today. It seems to come down mostly to concerns about their forward guidance and a shifting revenue mix. Those were kind of the elephants in the room for investors.
Absolutely. Let's drill down a bit. Adjusted EBITDA, that grew a solid 22% year over year to $13.68 million.
Okay. Decent growth.
Decent growth. Now, the margin did compress slightly, down to 35%. That's a couple percentage points lower. Worth noting.
But, and this is critical, I think, look at the cash generation. This company is basically a cash machine. Operating cash flow surged to $9.36 million. Wow, from, what was it last year? Almost nothing.
Yeah, just $0.19 million the prior year. And free cash flow grew 36% to $8.17 million.
Okay, so operationally, throwing off cash.
Absolutely. And what's also really interesting in that revenue mix is the sports data services revenue. It's quadrupled.
Quadrupled to how much?
To $10 million. And that's now about 25% of their total revenue. And crucially, it's recurring subscription revenue.
Okay, that jump in recurring sports data, that's definitely a key thread here. But let's dig into some other financial detail.
Go for it.
You might have seen the negative GAAP diluted EPS, minus $0.38. Now, if you just glance at that, it looks maybe alarming next to all the other good news.
Right, it seems contradictory.
But here's the insight. That negative figure was mostly driven by a big $21.2 million fair value adjustment. It's for contingent consideration.
Okay, translate that for us.
Sure. It's basically an accounting impact linked to their OddsJam and OpticOdds acquisitions. It's not actual cash going out the door right now, and it's definitely not a sign of operational problems.
So what does it mean then?
It actually means those acquisitions performed so well, much better than expected, that the company now anticipates owing more money later to the sellers under the earnout deals.
Ah, okay. So a negative accounting number that actually signals underlying success.
Exactly. It's sort of a good problem to have, as you said.
Yeah.
Reflects strong performance of those assets.
Makes sense. And speaking of the balance sheet, their financial discipline seems pretty clear. They paid off the final $11.2 million for freebets.com using cash on hand.
Cleaning things up.
And they're making smart moves on their debt, too. From April 1st, they swapped 75% of their U.S. dollar borrowings into euro borrowings.
Okay, why do that?
Well, it's projected to cut their interest costs by about 200 basis points, so 2 percentage points. Plus, it aligns with their functional currency.
Meaning less noise from currency fluctuations in their reports. Cleaner financials.
Exactly. Important for a global business like this.
And also, on capital management, the board okayed another $10 million for share buybacks.
Right, bringing the total authorization up to $20 million.
Yeah.
Though they haven't used any yet, have they?
No, not yet. But it gives them flexibility, right? And it signals management thinks the stock might be undervalued. It can act as a sort of floor.
Okay, so with all these financial moving parts, how is management actually positioning the company? What's the big picture strategy here?
Well, they're very actively trying to diversify away from relying so much on traditional search channels like Google.
Right, the SEO dependence.
Exactly. They're implementing what they call an omni-channel approach. So reaching users through apps, email, social media, YouTube, paid ads.
Full spectrum.
Pretty much. And
Yeah.
what's striking is they're reporting orders of magnitude growth in these non-search channels, not just, small incremental gains.
Orders of magnitude. That sounds like a fundamental shift they're trying to engineer.
It certainly seems that way. And the sports data services business, powered by OpticOdds and RotoWire, that's a core part of this diversification.
We saw the revenue jump there.
Yeah, OpticOdds specifically grew an amazing 120% year over year. And management even hinted the total market for this data business might be way bigger than they first thought.
Bigger how? Who's buying this data?
It's not just the betting operators, it's pro bettors, arbitrageurs, people looking for pricing edges.
Huh.
Apps, media companies, a really wide range of clients. And the revamped RotoWire is also pulling its weight, showing double-digit growth year on year.
So it's really about building this stickier, more diversified business with recurring revenue.
Precisely. High margin, recurring revenue. That's the goal.
And another big piece of news was the deal to acquire Spotlight.Vegas. Right, the Las Vegas focused one.
Yeah. It's an $8 million cash payment up front, plus potential earnouts up to $22 million over the next couple of years, tied to hitting EBITDA targets.
Okay, and what does Spotlight.Vegas actually do?
What's interesting here is it adds a transactional booking layer. Think hotel bookings, show tickets, that sort of thing.
So moving beyond just affiliate referrals for online betting. Exactly. It expands their client base to include land-based operators like Vegas hotels and casinos, and gives them another way to monetize their audience, owning more of that customer journey.
Got it. And what are the projections for Spotlight?
For 2026, they expect at least $8 million in net revenue and at least $1.4 million in incremental adjusted EBITDA from it.
And management framed this as opportunistic, right? Because Vegas occupancy is maybe a bit low currently.
Yeah, they mentioned current low hotel occupancy, but expressed confidence the city will bounce back. So buying it potentially a good time.
Makes sense. And the long-term plan
is to eventually use this booking platform on their own big sites, like casinos.com, and expand beyond Vegas. Think regional casinos, other hospitality providers.
So broadening the scope quite significantly, moving into travel and entertainment more broadly, not just pure online gambling.
Seems like it. Now we have to talk about the challenges. Google's algorithm updates were obviously a big topic on the call.
Understandably. Always a factor in this space.
Management acknowledged weaker search rankings, especially from an update that hit in Q3.
Mm-hmm.
But they framed it as, business as usual. Yeah. Said they're confident they can recover the lost positions and emphasized they're speeding up investment in those non-SEO channels we talked about.
Right. It's the perennial challenge for affiliates. Adapt or decline.
But is that confidence fully justified? Or is Google getting harder to navigate?
That's the multi-million-dollar question, isn't it? And related to that, they also talked about AI's impact on search.
Like the AI overviews potentially reducing clicks?
Exactly. They acknowledge that possibility, but they argue their big trusted brands, gambling.com, bookies.com, casinos.com, are actually well-positioned.
How so?
Their argument is that authority, trust, and expertise, the things they've built their brands on, are exactly what's needed to get surfaced by generative AI tools. They think the skills honed for SEO are directly transferable.
So they see AI less as a pure threat and more as a potential opportunity, banking on their brand strength.
That seems to be the message, yeah. They believe their authority will win out in the long run.
Interesting take. And looking even further out, they mentioned exploring prediction markets.
Yeah, they called it a fascinating category. See potential there, especially if the legal side gets clearer, maybe via the Supreme Court?
They sounded quite opinionated about the current U.S. sports betting setup, suggesting prediction markets might be more consumer-friendly.
They did. They seem to view it as potentially the next chapter of growth for the industry in North America. So definitely thinking ahead beyond just the current operational challenges.
Okay, so all of this brings us back to that initial market reaction, that sell-off after the earnings.
Right. Despite the strong beats on EPS and revenue, it really illustrates that classic beat but guide-tempered reaction.
Meaning the market liked the past performance, but not the future outlook.
Pretty much. The market sentiment was definitely mixed to cautious, and it was primarily driven by concerns about the quality of the updated full-year guidance and the expected margin compression. Investors keyed in on those forward-looking bits.
Let's quickly review that guidance then, because that seems to be where the market got hung up. For the full fiscal year 2025, they updated revenue guidance to $175 million.
Okay, midpoint there is still 36% year-over-year growth. Pretty healthy.
And adjusted EBITDA was guided to $64 million. Midpoint there is 29% year-over-year growth.
So still strong growth, but maybe slightly less growth on the EBITDA line than the revenue line implies margin pressure.
Exactly. And the adjustments reflect a few things. Positive contributions from Spotlight.Vegas coming online.
For about 4 months of the year, yeah.
And the expected launch of sports betting in Missouri in December.
Okay, so some tailwinds baked in.
But these positives are partly offset by, number one, those weaker search rankings from the Google updates.
The SEO headwinds.
And number two, a higher cost of sales. And that's because of the growing share of revenue coming from non-SEO marketing, plus strategic investments in those new digital channels.
Right. So connecting the dots, it's the near-term cost of making that diversification pivot we discussed. They're spending money to shift the business model.
And management was really clear on this point. They insisted the lower margins are entirely due to this mix shift towards those higher cost of sales channels.
Not because they can't monetize as effectively or because client demand is weak.
Correct. They reiterated their long-term target for adjusted EBITDA margin is still 35% to 40%.
Yeah.
They're saying the core profitability is there once this pivot fully scales.
Okay, so that's the narrative. Now, investors will be watching closely for proof points, signs of SEO stabilizing.
Or at least the non-SEO growth offsetting it effectively.
Right. Plus, seeing Spotlight.Vegas integrate smoothly and start contributing as expected.
And continued strong growth in those recurring sports data services. That seems crucial.
Absolutely. Those factors will really determine if they're on track for that bigger goal, becoming a more durable, less channel-dependent, $100 million adjusted EBITDA business down the road.
All right. Let's shift gears. Time to put on our investment committee hats. Now, obviously, the market is punishing Gambling.com Group right now for the Google issues and that slight margin dip from the channel mix.
Yeah, the focus seems very short-term.
But if you zoom out, you could argue there's a clear contrarian opportunity brewing here.
I'd agree. You've got what looks like a strong underlying business making a pretty fundamental and well-explained strategic pivot. Plus, multiple catalysts potentially on the horizon.
Feels like a setup for potential mispricing by a market maybe too focused on those single channel headwinds.
Exactly. We're leaning into that strategic shift and looking at the future revenue drivers.
Okay, here's our first outrageous but plausible pitch. We're calling it the AI pivot play. Long GAMB, short, a legacy SEO pure play.
Okay, lay it out.
The market seems stuck on the Google algorithm hit, maybe seeing it as a permanent dent in GAMB's core business.
Right, the old affiliate model under pressure.
But management is explicitly talking about becoming a multi-platform integrated marketing, data, and soon-to-be ticketing services business. They're putting resources into scaling apps, email, social, paid media.
The omnichannel thing.
And leveraging their brand authority for generative AI traffic. Our bet. The market is seriously underestimating how fast and effectively they can pull off this diversification.
So the play is?
Go long, GAMB. We anticipate that by late 2026, maybe sooner, these non-SEO revenue streams won't just plug the gap from search declines, they'll actually accelerate overall growth with a much stickier recurring revenue profile.
And the short side.
To hedge against maybe broader weakness in the affiliate sector or just amplify the bet, you pair it with a short position on a legacy affiliate pure play, one that hasn't shown such a clear, aggressive diversification strategy.
So the thesis is GAMB evolves and thrives as this diversified provider for the whole gaming and entertainment ecosystem.
While the less adaptable players get left behind, GAMB becomes the picks and shovels play.
Interesting. Okay, and for something maybe a bit more tactical.
How about this? Missouri Catalyst and Vegas Rebound. Call options on GAMB for December 2025 expiry.
Okay, focus on near-term events.
Exactly. Management specifically pointed to the Missouri sports betting launch in December as a positive lift for the full-year guidance.
And Spotlight.Vegas?
They noted Vegas occupancy is low now, but expect the city to bounce back. Spotlight is perfectly positioned to catch that rebound when it happens.
So it's a classic buy the dip ahead of Catalyst's idea.
Pretty much.
Yeah.
The market's fixated on the rearview mirror Google. We're looking forward. Missouri launch plus early signs of a Vegas recovery.
Which could give the stock a significant near-term boost that isn't fully priced in right now, given the focus on margins.
Exactly. And the December expiry gives enough time for Missouri to launch and maybe for the market to start seeing that Vegas potential. Plus, you have that increased buyback authorization potentially providing a safety net.
Aggressive plays, both of them. but they definitely reflect conviction in the strategic direction they've laid out.
Okay, so wrapping this up, Gambling.com Group, they delivered a financially solid Q2. Strong revenue, strong adjusted EPS growth.
Driven in large part by that booming sports data services segment.
Right. But they are facing real near-term headwinds from Google's updates, management's response, an aggressive strategic pivot.
Yeah, towards omni-channel marketing, high-margin recurring data subscriptions, and now adding that transactional layer with Spotlight.Vegas.
It's a significant transformation they're undertaking.
And despite that big share price drop after earnings driven by those guidance concerns around search and the mix shift impacting costs, the company seems to have a constructive long-term view and, importantly, a strong balance sheet to fund this pivot.
The success really hinges on execution now, doesn't it?
Absolutely. Integrating Spotlight effectively, keeping that recurring revenue growing strongly, and just skillfully navigating this constantly changing digital marketing world. That's what investors will be watching.
Okay, just a reminder for everyone listening. The discussions, and particularly those trade ideas we just threw out, are purely for informational purposes. They are definitely not financial advice.
Investing involves risk, significant risk sometimes. Past performance doesn't guarantee future results.
Please, do your own research, your own due diligence, and always consult with a qualified financial advisor before making any investment decisions.
Couldn't agree more.
Thanks for tuning into the Deep Dive. We'll be back soon with more in-depth analysis.